You're probably wondering how you compare to the average person when it comes to money. Are you ahead or behind in regards to your finances? How does your earnings and spending compare to others? Some of these financial statistics of the average person are absolutely going to surprise you. In fact, these numbers are probably going to be pretty eye-opening. My name is Chris, and I help teach people about money, personal finance, and investing. If you want to become financially free and not have to worry about money, make sure to subscribe to the channel and like the video if you find it helpful. Housing equates to about 34% of spending for the average household, according to the U.S. Department of Labor Statistics, making it the largest expense for just about every budget. This equates to about $1,900 per month. In the current market, renters are faced with rent increases and difficulty finding homes to rent, and homeowners are faced with rising home prices, skyrocketing interest rates, and other rising costs, such as insurance, taxes, utilities, and maintenance. These factors make both renting and buying less affordable. Spending too much in this one area can be detrimental to your budget, making it hard to pay for other expenses. If a huge chunk of your income is immediately spent on keeping a roof over your head, it doesn't leave much left over for transportation-related costs, food, and other necessities. It's nearly impossible to get ahead if this one expense is consuming a large portion of your income. Bankrate says the average payment for a new car is $700 per month, and the average payment for a used car is $525 per month. These amounts might sound ridiculous, and that's because they are for most budgets, but thankfully, most families aren't spending this much on a car payment alone. Value Penguin says that the average family spends a total of $819 per month on transportation, which is the second largest spending category just behind housing. Total monthly spending of over $800 per family isn't that out of reach, considering this includes all transportation-related expenses, such as gas, insurance, maintenance, car purchases, and so on. Unfortunately, many people are tempted by the thought of a brand new car, and they see it as a way to reward themselves. While it might make sense for some people, let's not forget that it's still going to spend most of its time parked in your driveway. The average age someone buys their first home reached an all-time high last year, according to the National Association of Realtors, at 36 years old, up from 33 years old just a year prior. Even though there are loan programs available to help first-time homebuyers purchase a home with 5% down or less, this doesn't automatically qualify them to borrow. Limited inventory has pushed prices higher over the past few years, and other costs previously mentioned increase overall expenses. The average home price in 2022 was about $350,000, according to an article published by The Zebra. Factor in taxes, insurance, utilities, and the cost of maintenance, and this could easily match the monthly mortgage cost. While homeownership costs are certainly on the rise, that's not the only thing increasing. The average home size has been steadily rising over many decades, contributing to these higher prices, and homebuyers are arguably fussier than before. Fewer and fewer buyers are willing to settle for homes with single bathrooms, fewer bedrooms, and outdated kitchens. The average federal student loan debt is almost $38,000 per borrower, and private student loan debt averages almost $55,000 per borrower. These figures show that the average student loan debt has tripled since 2007, according to educationdata.org. $38,000 or $55,000 of debt might not sound like much in order to obtain a higher level of education, but this debt can be crippling for a new graduate. Upon graduating when you're entering a career field with no experience, entry-level pay doesn't get you very far, and think of all the other expenses a newly graduated adult is likely to incur. In addition to these student loans that need to be repaid, these graduates are usually now on their own paying rent, and many of them decide to finance a newer car to replace what they were driving through school. To add insult to injury, many of these students didn't research the return on investment when it comes to choosing a major. As a result, they're now obligated to pay back an education with a salary that doesn't correspond. The average person in the United States pays $1,233 every month towards debt payments, as found by LendingTree. This total includes car payments, personal loans, credit cards, student loans, and even mortgage payments. For homeowners whose mortgage is included in this amount, it doesn't seem too bad. Unfortunately, not everyone included in this survey owns a home. Just imagine bringing home your paycheck after taxes, being required to pay over $1,200 in debt payments, and trying to pay your bills and save for your future with what's left over. Monthly payments are a dangerous trap, not only because you're paying huge amounts of interest to the banks and credit card companies. This debt makes it extremely difficult to save for future expenses, meaning you'll be forced to borrow even more money when new expenses pop up. Not to mention the fact that consumers have a tendency to overspend and buy things they don't need when given the option of paying for things over time. A 2019 study by Ladder and OnePoll found that on average, Americans spend about $1,500 per month on non-essential items, or $18,000 per year. That seems like a lot of money when you consider how many people are struggling, yet they put the blame entirely on outside factors instead of their own spending behavior. This figure includes dining out, subscription services, impulse purchases, and other items purchased that are completely unnecessary. It's important to reward yourself for hard work, and this is an important part of achieving a balance with money, but you should have your priorities in line. In other words, those who are spending $1,500 on non-essentials should first make sure they're paying themselves first and keeping debt under control, not the other way around. When you hear someone complaining about how broke they are and how they have no money, it makes you wonder if they're wasting $1,500 per month. Those reaching retirement age aren't getting there with millions saved. It's actually pretty far from it. The median amount saved for retirement for those ages 55 to 64 was $134,000, as found by the Federal Reserve. Those aged 65 to 74 had $164,000 set aside for retirement on average. On their own, these amounts saved will not go very far considering modern-day living expenses. Consider that a $200,000 nest egg will produce about $8,000 per year if using a 4% safe withdrawal rate, and the average Social Security benefit is about $1,550 per month. Social Security income alone might be enough for frugal, low-spending retirees who share a household and are able to split large expenses, while others will need to continue working, at least part-time, to make ends meet. These figures are easy to exceed by keeping a small portion of each paycheck. The median income for individuals aged 20 to 24 is just over $30,000, as found by the Bureau of Labor Statistics. For those ages 25 to 34, the median income rose to $51,000, and for those aged 35 to 44, the median income rose to just over $60,000 per year. The 45 to 54 age group saw a final increase to about $61,000 before it began to level off and slightly decline. Where you live plays a large part in determining whether or not these are comfortable incomes. In states with high costs of living and high taxes, $50,000 or $60,000 won't get you very far at all. However, in areas with a low cost of living and low taxes, this amount could be plenty to live comfortably. Of course, it also makes a huge difference whether or not you live by yourself. If you're responsible for the entire cost of rent or other housing cost, it's much harder to get by on an average income, while those with roommates or spouses to share expenses with have much more room in their budget. By looking at these numbers, you can gain an understanding of the situation of the average person, and you'll probably conclude that many people have some room for improvement. It's not necessary to be in a constant state of struggle when it comes to money, and you don't have to be average either. It's easy to be well above average with a little bit of discipline and forward thinking.